Hey, welcome to Dow Stock Talk, where I talk about topics relating to investing and finance, but more specifically, the stock market. Now, in this video, I'll be going over moving average. Now, before we get started, you know it. Make sure you smash the like button because it helps the YouTube algorithm. It helps YouTube know that this is quality content and help my videos reach a broader audience. Okay, we're going to be going over moving average. In the first part, I'll be going over the conceptual, and then the second part, I'll be going over an actual example. So this should be one of my shorter videos, but just to let you know, I provide the timestamps below so you can skip around as you like. So moving average, what is moving average? So moving average is a way that you can smooth out the price action because the stock market ends up fluctuating a lot. It ends up going up and down, up and down. So moving average kind of helps smooth that out to give you a baseline of the average price. Okay, so the idea of moving average, it can help you know as a baseline. So this will be an indication of, if you can see this picture, of when it can give you an indication of when to buy and sell. So if you look at here, once the stock price goes below the moving average, then it could be a signal to sell. And once it becomes above the moving average, it could be a signal to buy and sell. So this is, I'm just letting you know by theory. So I'm just kind of simplifying things, but that's pretty much the main idea. Okay, so exactly what is moving average? Exactly how do you actually calculate it? Now, I'm just letting you know this is just for educational purposes. You don't actually really have to worry about any of this, but just know this. The moving average is, so if it says 5-day moving average from the past 5 days, you would take that, the price, add them all up and divide it by 5. Same thing for 10-day moving average, you would take the last 10 days, divide it by 10, and then you would get each plot point. So when you do the 5-day moving average, the stock price in the past 5 days, you take them, add them all up, divide them by 5, 10, you add up all the prices, divide it by 10. So it's pretty much the average. And each day, as you move on, you drop the last one out. So the next day, you would take another 10. The next day, you take another 10. You end up plotting points, and that's how you get the moving average. For exponential, it's pretty much similar, but for exponential, just know that the later days are weighed more heavily. So whatever price action happened in the later days, it will have more of an impact on the line. So this will be an example of a simple moving average and exponential. Now, for my personal experience, if I'm looking at a much shorter period of time, I like the exponential because it'll give you a faster reaction versus the simple. So simple moving averages, if you're looking at over for a longer period of time, simple moving average could be fine. But if you're looking at a shorter period of time, exponential moving average. So as you can see, the simple moving average is the yellow, the exponential one is in the white. So as you can see, the exponential gives you a faster indication of the price than the simple moving average. So for a short period of time, exponential would be better in my opinion. Long term, it really doesn't matter. Long term, I think simple is more than enough, but I just wanted to go over that. Okay, so the next thing I wanted to show you, and by the way, if you doesn't know how to read the stock chart, don't worry, I provided a video. Just check the suggested videos. So some common moving averages is 10-day, 20-day, 50-day, 100-day, and 200-day. So the thing about moving averages is there's two main components that I want to talk about when you see could be a signal to buy and sell. It's the golden cross and the death cross. So right in this picture, you're looking at the stock price and the candlestick or candle chart, where you can see this is the 200-day moving average. So pretty much it means the golden cross, whenever you have the lower moving average passing the higher moving average, that's what they consider a golden cross, could be a strong signal of a buying opportunity. So it could, the number of the days doesn't actually matter, but just know whenever the lower moving average passes the higher moving average, that means it's an upward trend and it's a good indication to buy. And the next one I wanted to go over, this is another example of the golden cross. So at this one, we're looking at the 200-day moving average. And the reason why I wanted to go over, two different examples so you can see how the actual number doesn't actually matter. But this one is the 200-day moving average, and the green is the 50-day moving average. Whenever the 50-day, the lower number passes the higher number, it's the golden cross, and it means that it's an upward trend, it's gaining momentum, so it's definitely a buy signal. Now, at this particular one, this is what we call the death cross. So when you see this, this is never good. So not unless you're shorting a stock, but that's for a whole nother ordeal. This is for beginners, so I'm not really going to cover that too much. So if the blue is the 50-day moving average and the red, which is the 200-day moving average, so whenever the lower number passes the higher number, then that's what we call a death cross. So the 50-day moving average is dropping below the 200-day moving average, which means based off of a longer time span, the shorter time span is going below the longer time span, which means it's an indication to sell. It's losing momentum. As you can see, it's coming a downward trend. So that's never good whenever you see a death cross. And don't worry, I'm going to show you the actual example of a real stock chart. So if you don't actually follow this, I'll compare the practical and the application, so you don't have to worry about that at all. Okay, so now this is an actual stock chart. We're looking at Nike from the past 2 years. We're looking on the one-day interval for 2 years. If you can see, it's the 50-day moving average. It smooths out the price of the stock, so you can get the average. That's why it's called moving average. So the thing about the moving average, if we can just go in a little closely, like we said before, whenever it drops below the moving average to sell, once it goes above the moving average is a buy. So as you can see, I'm just giving different examples. Buy, sell. Oops. Now some of these, as you can see, it becomes a little tighter. It'll be definitely harder to be able to tell, but it's some of them whenever there's a bigger break, it's easier to buy there, sell there. So I just wanted to give you a general, this is very I'm oversimplifying things about the moving average so you can just have a rough understanding. And also I just want to mention that I'm trying not to confuse you a little bit, but sometimes people use moving average as supports and resistors. By the way, if you want to check out support and resistors, I did a video on this, but this is a different way that you can look at it. Some people, what they'll end up doing is whatever it's an upward trend, they use the moving average as a support. So that meaning like the price, as long as it's above the moving average on an upward trend, it would be considered a support. Now, what they consider resistance is the point where it would be below the moving average on like a downward trend. So that when they say a downward trend, they would consider this part as the resistor, and upward trend, they would end up using it as the moving average as a support. Now, if you don't really get that too much, don't really worry about that too much, but I just wanted to mention so you will be familiar with how some people end up using the moving average as supports and resistance. All right, and last but not least, we're going to go over what I was telling you about the golden cross and the death cross. So as you can see, we have the moving average, and by the way, let me actually just go over something really fast so you can see the slight difference between exponential and simple. Once again, I said exponential I will use in the short term, simple moving average I will use in the long term. So by the way, when we click up here, this is Yahoo Finance. You see the period. So these is where you can end up changing a 10-day, 20-day, 30-day, whatever you need. So right here where it says type, right now I'm going to switch them both to simple so I can end up showing you something. So remember, the 50-day moving average is in the red, 20-day moving average is in the green. All right, so 20-day moving average. Okay, now as I want to also mention, this is very important, and this is why it's kind of trading is end up being sometimes can be a little difficult. Now, the technical indicators are lagging indicators. So what does that mean right there? It means that they react after the price had already dropped. See, you see the price has dropped, but the indicators lags that. So that's why it's very difficult to just kind of buy and sell, because the indicators tell you after the fact. So that's why they kind of call it confirmation. That's why when you kind of looking backwards, it seemed like, oh, it's easy buy to sell, buy and sell. But these technical indicators actually lag the price action. So you kind of have to anticipate it beforehand, which could be very tricky, especially since there's so many different things that can impact it. All right, but I wanted to focus in this area right here. As you can see, now I want you to pay attention to this. Pay attention to this candlestick in particular right here. So see how it is with simple? I just wanted to show you this. And when I say exponential, because exponential identifies it, it reacts a little closer to the price action than simple. So remember this one? Okay, so now I'm going to switch it to exponential. And I really want you to pay attention to these two lines and really pay attention to this candlestick right here. Now I'm going to switch this to exponential. I'm going to switch this to exponential. And see how right there, the exponential captures it quicker than the simple day moving average. So if I'm trading on a much faster time period, that's why I particularly like the exponential. Of course, if you're looking at a longer time span, it doesn't really matter. But exponential one definitely captures it, because remember that with the exponential, the later days are influenced much heavier. So whenever you see a major price swing, exponential will definitely capture it faster than simple average. So with the green, you have the 20-day, the red, you have the 50-day. Because the 20-day is going below the 50-day, that would be what we consider the death cross. I'm going to bring it up on the screen. Remember, the death cross is when the lower moving average goes below the higher moving average, and that would be an indication to sell. Now, when we're looking at the golden cross right here, whenever we see golden cross, we know that it's good. So as you can see, the red is the 50-day moving average and the green is the 20-day moving average. As you can see, when the 20-day moving average passes the 50-day moving average, when the 20-day moving average passes the 50-day moving average, we know it gives us confirmation that it's an upward trend, and it gives us confirmation that it's an upward trend and a signal to buy. Death cross, sell. Golden cross, buy. Now, from my personal experience, I would definitely use other indicators, because moving average alone to me doesn't tell the full story, not unless you're using, I guess, a more comprehensive not unless you have more of a comprehensive strategy and you've been looking at charts for a while. But I definitely also wanted to show you this right here. And I definitely really want to go over this, because just simply looking at it after it already happened, you might, oh, it's easy to buy and sell and buy and sell. But here's the problem. Let's zoom in right here. So I really want to give you an indication. See right here, the price has already been starting to go up a lot. Actually get the not the death cross. We didn't actually get the golden cross to all the way right here. So if you can see, there was a big upswing before we got the confirmation. So those are some of the things that when you're looking at trading, you have to be careful. And when you're really looking at it up close, it doesn't give you that clear indication. So the closer you look up, it's very hard to identify it. That's why, because this is going over for beginners, I just wanted to let you know what's some of the things about it. Now there's other technical indicators that you can use to give you a better indication, but this one we went over moving average. And in my other videos, I will be going over other technical indicators that you can end up using. And that concludes this video. Make sure you let me know in the comments below, do you use moving averages? And if you haven't already, make sure you hit that like button. And if you're new, make sure you subscribe to my channel.